The Federal Reserve recently took a bold step by cutting interest rates by 50 basis points, marking a significant shift in monetary policy. While this move surprised many analysts who were expecting a more modest 25 basis point cut, it has raised important questions about the future direction of the economy, inflation, and the Fed's thinking. Let's break down what this could mean for you as an investor. First off, Fed Chair Jerome Powell's rationale for the larger-than-expected cut remains somewhat unclear. During his press conference, Powell reiterated several times that the labor market was in strong condition and that the economy was growing steadily. In fact, he mentioned that third-quarter GDP was on track to grow at around 2.2%, a solid figure. Inflation also continues to cool, aligning with the Fed's long-term goals. But despite these positive signals, the decision to cut 50 basis points seems to raise more questions than it answers. Looking ahead, the Fed's projections, based on its dot plot, suggest additional rate cuts are coming. It's expected that there will be another 25 basis point cut at the upcoming meetings, which could bring the Fed funds rate down to the 4.25 to 4.50% range by the end of this year. Going into 2025, the central bank anticipates the Fed funds rate to range between 3.0% and 3.50%, depending on how inflation trends evolve. Many are watching for inflation to fall below the Fed's 2% target by next year, which could open the door for even more cuts, especially as economic growth is expected to slow in the coming quarters. Now, what does this mean for long-term rates? We are likely entering a multi-year period of declining interest rates. The forecast for the 10-year Treasury yield stands at around 3.75% next year, falling to 3.25% in 2026 and hitting 3.0% in 2027. For investors, this means a potential opportunity in bonds and other interest rate-sensitive assets. The market has been trying to digest this rate cut, and investors will be closely watching Fed officials' speeches over the next week to get a clearer sense of their future plans. There are still many uncertainties, and the market is split on whether another 50 basis point cut could happen later this year. With all these dynamics in play, investors are trying to determine how these rate cuts will impact economic growth and the stock market. Now let's look at the broader economic picture. While the Fed's decision suggests some concern about the economy, current data points show resilience. GDP growth remains strong at 2.9%, according to the latest estimates. However, there are some worrying signs, particularly in the industrial sector. Companies like FedEx and UPS have reported weaker than expected earnings, which could hint at a slowdown in the economy. But it's still too early to conclude if this weakness is temporary or a sign of broader issues. When it comes to corporate earnings, there are a few key companies to watch this week. Micron, one of the world's largest semiconductor companies, is expected to benefit from the ongoing demand for AI technologies and data centers, which require large amounts of memory and storage. The company's stock is currently undervalued, trading at a discount, and could see strong growth over the next year. However, it's important to note that Micron doesn't have an economic moat, meaning it may face challenges from competition in the long run. Another major player reporting earnings this week is Costco. While the company is a favorite for many, its stock is currently trading at a premium, making it overpriced for new investors. The key thing to watch with Costco will be any commentary on consumer spending trends, particularly among higher-income households. Carnival Cruise Lines is another stock to keep an eye on, especially as it serves a similar demographic. The company's earnings will provide further insight into consumer demand for travel and luxury services. Carnival stock remains undervalued, trading at a discount to its fair value, and it's one of the companies that has a durable competitive advantage. Now let's shift focus to some undervalued stocks that could benefit from the current easing in monetary policy. One stock worth considering is Healthpeak Properties, a real estate investment trust, or REIT. Healthpeak trades at a significant discount and offers a 5.5% dividend yield. With interest rates set to decline over the next few years, the real estate sector, including REITs like Healthpeak, could experience a boost. The company owns a diverse portfolio of healthcare properties, making it a defensive play in uncertain economic times. Crown Castle, another REIT specializing in cell towers, is also worth mentioning. The ongoing rollout of 5G technology and the growing demand for data means Crown Castle is well positioned for growth. The stock has already seen an 18% rise, but remains undervalued by about 15%. With a strong dividend yield and solid long-term growth prospects, this is another stock that could benefit from the market's rotation into value stocks. In the banking sector, U.S. Bancorp stands out as the largest regional bank in the United States. While sentiment around regional banks has improved since the turmoil earlier this year, U.S. Bancorp still trades at a discount. The company has strong credit metrics and recently increased its dividend, signaling confidence in its balance sheet. With its wide economic moat, this bank remains one of the top picks in the sector. Lastly, let's talk about Evergy, a regulated electric utility serving Kansas and Missouri. Evergy is one of the few undervalued utility stocks left in the market. With improving fundamentals, this stock has the potential for growth, especially if management raises its outlook later this year. To summarize, while the Federal Reserve's recent rate cut has raised many questions, it also presents opportunities for investors. Companies like Healthpeak Properties, Crown Castle, U.S. Bancorp, and Evergy are positioned to benefit from a lower interest rate environment. Keep an eye on these stocks, along with the broader economic trends, as you navigate the market in the months ahead.